Chapter 5 Financial Services Part 1 Script Indian Financial System Chapter 5 Financial Services Part 1 Meaning of Financial Services. Financial services are the products and services provided by financial institutions to help people and businesses manage, grow, and protect their money. The word financial means related to money, and services means work done for someone else. So financial services means professional help given to people for managing their money. These services are offered by organizations like banks, insurance companies, stockbrokers, and investment firms. They help people save money, take loans, invest wisely, get insurance, and make payments easily. For example, when you deposit money in a bank, take a home loan, or buy health insurance, all of these are financial services being used in real life. Importance of financial services. Economic growth. Financial services collect savings from people and direct them into productive investments, which helps the economy of a country grow steadily. Promotion of savings. Financial services encourage people to save money by offering deposits, fixed deposits, and other saving options with good returns. Capital formation. By collecting small savings and turning them into large investments, financial services help create capital, which is the foundation of economic activity. Provision of liquidity. Financial services make it easy to convert assets into cash quickly, ensuring money keeps flowing smoothly through the economy at all times. Financial intermediation. Financial services act as a bridge between people who have money to save and businesses that need money to grow and operate. Creation of employment. The financial services industry creates millions of jobs worldwide, from bank employees to insurance agents to stockbrokers and investment managers. Features of financial services. Customer-oriented. Financial services are always designed keeping the customer in mind, matching different products to the varied needs and risk levels of each person. Intangibility. Financial services cannot be touched or seen like a physical product. They are based on trust, reputation, and the quality of service delivered. Simultaneous performance. Financial services are produced and delivered at the same time. Unlike a product, you cannot make a service first and deliver it later. Dominance of human element. Financial services depend heavily on skilled people. The quality of service changes based on who is delivering it and to whom. Perishability. Financial services cannot be stored or saved for later. If a service is not used when it is available, it cannot be inventoried or carried forward. Objectives of financial services. Riaz notes. To raise funds, financial services help businesses and individuals raise the money they need from investors, banks, and financial markets using various instruments. To develop funds, financial services ensure that money raised is properly deployed through options like bill discounting, money market investments, and credit management. To ensure specialized services, financial services provide specialized products like mutual funds, credit cards, venture capital, and lease financing beyond basic banking. To follow regulation, financial services operate under regulatory bodies like SEBI and RBI in India to ensure all activities are legal, safe, and transparent. To concentrate on economic growth, financial services speed up economic development by making money available to businesses and individuals who need it to grow. Functions of financial services. Banking services. Banks accept deposits, provide loans, issue credit and debit cards, and help people transfer money safely and conveniently every day. Investment services. Financial institutions help individuals and companies grow their money through stocks, bonds, mutual funds, and professional asset management services. Insurance services. Insurance companies protect people from financial losses by offering life, health, property, and liability coverage in exchange for regular premiums. Financial planning and advisory. Financial advisors help people set goals, create budgets, plan investments, and manage their overall financial health for the future. Payment and transaction services. Financial institutions enable safe and fast payments through online banking, mobile payments, electronic transfers, and merchant services. Wealth management. Wealth management services help high-income individuals manage investments, plan taxes, handle estates, and grow wealth across generations. Types of financial services. Fund-based financial services. These are services where the financial institution directly provides money to clients in the form of loans, advances, or investments to earn interest or returns. Fee-based financial services. These are services where the financial institution earns income by charging fees or commissions for advice and facilitation, without directly lending its own money. Fund-based financial services. Fund-based financial services are services where financial institutions directly provide funds to their clients in the form of loans, advances, or investments. The word fund means money and based means it depends on. So fund-based services means services that depend on the actual giving of money to the client. In these services, the bank or financial institution uses its own money to help the client. The institution earns income through interest, dividends, or capital gains on the funds it has deployed. For example, when a bank gives a home loan to a customer, the bank is directly providing its own funds to the customer. This is a fund-based financial service. Features of fund-based financial services. Direct financial assistance. The financial institution directly gives money to the client as a loan, advance, or investment, unlike fee-based services, which are advisory in nature. Interest or return-based revenue. The institution earns money through interest on loans, dividends, or capital gains from the funds it has deployed with clients. Higher risk exposure. Since real money is given out, the institution faces the risk of the borrower not repaying or investments not performing as expected. Asset backing. Fund-based services usually require the client to provide collateral or security to protect the lending institution's money in case of default. Short and long-term financing. These services cover both short-term needs like working capital and long-term needs like purchasing machinery or infrastructure. Regulated by authorities. Fund-based services are strictly regulated by bodies like RBI in India to ensure financial stability and compliance with rules at all times. Types of fund-based financial services. Factoring. A financial company manages a client's sales ledger and collects payments from debtors on the client's behalf, providing immediate cash against invoices. Leasing. A firm gets to use a fixed asset by paying regular installments to the owner, without actually purchasing the asset outright. Hire purchase. Goods are bought and sold in installments where the buyer gets possession immediately, but ownership transfers only after the last installment is paid. Housing finance. Financial institutions provide loans specifically for building or buying houses, with National Housing Bank being the apex institution in India. Bill discounting. A bank buys a bill of exchange from the holder before its due date by paying the amount after deducting a discount as its fee. Venture capital. Investors provide money to new startup businesses with high growth potential in exchange for equity, accepting high risk for potentially high returns. Meaning of fee-based financial services. Fee-based financial services are services where financial institutions earn income by charging fees or commissions for advice and facilitation, without directly lending their own money. The word fee means a charge for a service. So fee-based services means the institution gets paid a fee for the work it does, not for the money it lends. In these services, the institution uses its expertise and knowledge to help clients make decisions or complete financial transactions. Since no real funds are deployed, the financial risk for the institution is much lower. For example, when a credit rating agency rates a company's bonds and charges a fee for that evaluation, that is a fee-based financial service. Features of fee-based financial services. No direct fund involvement. The institution does not lend or invest its own money. It earns by providing expertise, advice, or acting as a middleman between parties. Revenue through fees and commissions. Income is earned through consultancy charges, commissions, or flat fees for the services rendered to the client. Low financial risk. Since the institution's own funds are not at risk, the financial exposure is much lower compared to fund-based services. Focus on expertise. These services require deep knowledge and specialized skills in areas like investment management, corporate finance, or risk assessment. Wide range of services. Fee-based services cover diverse offerings like merchant banking, stockbroking, credit rating, portfolio management, and underwriting. Client-centric. These services are customized to meet the specific financial needs and goals of each individual or corporate client they serve. Types of fee-based financial services. Merchant banking. Merchant bankers help companies raise capital by managing securities issues and providing corporate advisory services to businesses. Stockbroking. Stockbrokers help retail and institutional investors buy and sell shares on stock exchanges, earning a commission on every trade executed. Credit rating. A credit rating agency evaluates and rates the creditworthiness of a company or financial instrument to help investors assess risk before investing. Portfolio management services. A professional portfolio manager invests and manages a client's money across stocks, bonds, and other securities on their behalf. Underwriting. Investment bankers raise capital for companies by guaranteeing to purchase any unsold securities during a new issue, taking on the selling risk themselves. Securitization. The process of converting a liquid loan assets of a bank into tradable marketable securities that can be sold to investors in the market. Meaning of leasing. Leasing is a process where a firm gets to use a fixed asset by paying regular contractual payments to the owner without actually purchasing the asset. The word lease means a legal agreement to use something for a period of time. So leasing means getting the use of an asset through a formal agreement while paying regular rent for it. In leasing, the owner of the asset is called the lessor and the one who uses it is called the lessee. The lessee pays regular amounts called lease rentals and gets full use of the asset without owning it. For example, a company that needs expensive machinery can lease it instead of buying it, paying monthly rentals and returning it when the lease period ends. Types of leasing. Financial lease, a long-term, irrevocable lease where the lessee pays more than the cost of the asset over time and bears all maintenance costs throughout. Operating lease, a short-term lease where the lessor bears maintenance costs and the risk of the asset becoming outdated, with an option to terminate after notice. Sale and leaseback, a company sells its own asset to a lessor and then leases it back, getting immediate funds while still being able to use the same asset. Leveraged lease, when the asset value is very high, the lessor involves a third-party financier who has a charge over the leased asset to fund the deal. Conveyance-type lease, a long-term lease with a clear intention from the beginning to eventually transfer ownership of the asset to the lessee at the end. Specialized service lease, the lessor is a specialist in the asset being leased and provides specialized personal services to the lessee along with the asset. Advantages of leasing. Saving of capital. Leasing provides 100% financing for using an asset with no down payment needed, freeing up the lessee's capital for other productive business purposes. Flexibility and convenience. The lease period and rental amounts can be customized according to the specific needs and financial situation of each lessee. Planning cash flows. Lease rentals are fixed and predictable, making it easier for businesses to plan their cash flows and manage their finances efficiently. Improvement in liquidity. Through sale and leaseback, a business can convert an owned asset into immediate cash while continuing to use the same asset for operations. Thank you for watching. Watch part 2 for factoring, credit rating, and venture capital. Don't forget to subscribe. Riaz Notes.